Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying this show, do me a quick favor. You got to leave us a rating and review. I want to hear what you love about the show or anything we should work on to make it work harder for your investing goals. And also, if you haven't done so already, be sure to hit that subscribe button so you don't miss an episode. Today, we've got a returning guest. We're going to be talking to Jeremy Goodrich. Jeremy Goodrich is a commercial real estate insurance advisor who's been teaching investors how to buy and protect properties since 2013. He's the owner of Shine Insurance, which aims to protect some of the top real estate investors in the country, and the creator of the New Home Buyer's Guide. Now, he'll explain why 80% of real estate investors aren't properly protected and how you can fix that. Let's welcome to the show, Jeremy Goodrich.
John, it's so great to be on your show. Looking forward to talking about risk management, insurance, just pulling back the curtain on this piece of the investing journey that I think so many people feel disgusted or annoyed or just confused about. So hopefully this episode can really help them with that.
Yeah, absolutely. And Jeremy, listen, we had you on the show before. We'll make sure we link to that in our show notes. But for those people who are not familiar with you or your story, why don't you take 2 minutes and fill in some of those gaps?
Yeah, so I started my adult life as an elementary school teacher. I love teaching third and fourth graders about math, about reading, about writing, just like helping those kids to explore the world. And, again, I spent 13 years doing that and I loved it. At some point, I decided that making $25,000 a year just wasn't cutting it. I was building up credit card debt and it just wasn't working anymore. At that point, I'd met my wife and business partner. We started Shine Insurance with the goal of changing the way people feel about insurance. And right from the beginning, I really dug into real estate. I felt like, how can I serve the real estate community? I started with first-time home buyers, just like teaching them how to buy a house. Yeah, of course, insurance was a piece of that picture, but it was just like, how to find a good realtor, a good lender, a good appraiser, a good, title company, all the things that come with buying a house. And that built into teaching folks how to invest in residential real estate, 1, 2, 4 unit properties or fix and flips, things like that. And then for the last few years now, I've been involved purely in commercial real estate, both teaching people how to purchase and protect, with an emphasis mostly on the protect side, really managing the risk associated with commercial real estate of all kind. That includes office, retail, industrial, multifamily, self-storage. Those asset classes are the ones we focus on the most.
I love it. And the thing that's really cool is that there's a theme of teaching throughout all of your experience, right? You talked about being an elementary school teacher and teaching those kids, obviously, then moving into the insurance space and teaching first-time home buyers what to look for, how to find agents, how to find different vendors that they need. And then as you moved into the commercial real estate insurance space, now you're doing the same thing, teaching people how to identify risk, manage risk, and protect their investments. Let's dig into that a little bit more, right? As the economy is starting to shift and change, we are seeing more and more people try to figure out what they need to do to protect themselves in this current economic climate. What are some of the things that you're seeing as some of the concerns you have that are going on right now in this current market?
Yeah, I mean, there's just less of a barrier for mistakes, right? A few years back, you could have a business plan in your investment journey that maybe wasn't as tight, maybe had less room for error, maybe had fewer exit strategies or just one exit strategy, and you could get away with it. And I think as the economy shifts, as we've seen in other cycles, what you can and can't get away with becomes much smaller, right? And so every single line item on your pro forma has to be thought out really, really carefully on the front end. Your asset management through the cycle of your property has to be really, really good. And your exit strategies have to be variable. We don't know what it's going to look like in 3 years from now, but we have to be able to look forward to that, especially if we can't pick up the debt from the person we're buying from. We have to look at, interest rates as we have them right now. So I think the biggest thing about the economy as it stands from a general perspective right now is just that limited room for error. It's such a smaller margin, which means your listeners and every investor out there has to, dot the I's, cross the T's more than they had to a year ago. Is that what you're seeing as well?
Yeah, I mean, pretty much. I mean, to your point, I mean, just understanding where those challenges are, tightening up the underwriting, making sure that we're being conservative. And lenders are requiring this too. I mean, in the past, lenders would be, they'd give you 75, 80% LTV, so loan to value. We're not seeing as much of that, at least not with healthy reserves and other requirements that come with it. As a matter of fact, I did an interview yesterday, and it was an interview with Rod Cleef, and Rod mentioned that there was a deal he was looking at, and the reserve requirements went from, and this was not him, but the current
Mm-hmm.
owner of that property. The reserves went from $8,000 a month to $80,000 a month. So a flat
Mm-hmm.
out 10x of the
Right.
reserve requirements. So those are some of the things that you're starting to see now, which is kind of mind boggling, but it just goes to the show that, hey, people are a little nervous. Those reserves are going to be, a little bit higher, and you want to make sure you protect yourself. I know another thing that I've seen, and you've posted about this frequently on LinkedIn, is we are seeing a big change in the insurance industry as far as what kind of properties insurance agencies are willing to lend on, what those quotes are coming in at. Talk to us a little bit more about some of the changes you're seeing.
Yeah, I think we have to start at the foundation, and that is to understand that everyone that you're talking about and that I'm about to talking about is essentially managing risk, right? When things tighten, everyone starts to look at risk in a slightly different scenario. When someone's asking for a higher reserve, what are they concerned about as a lender? Well, they're concerned about the risk of things going wrong. They want to see that you have more capital available, that you have more capacity to handle downside because they're seeing the more potential for downside. And so, as we look through each element, if we understand the concept of risk, the concept that everyone is trying to balance opportunity, upside, and bad things that can happen, downside, and figure out what those two things balance to make it work, we can understand not only from our own perspective and our own investing journey, but also from the perspectives of whoever we're trying to work with, whether that's a lender, whether that's an insurance advisor, whether it's an attorney, whether it's a seller, whoever it is. Everybody's trying to balance these same things. And when the economy tightens, the tolerance for risk tightens. So in the insurance scenario, we're seeing that as well. We're not just seeing that because of the economy, though, really. I mean, the tightening that we're seeing in the insurance scenario is historic. It has a history to it. The things that are affecting insurance premium right now are the economy. It costs more money to borrow and things of that nature, so that an inflation is there. And so that's going to be figured into an insurance premium. But that's just one small piece. Another piece is the cost to rebuild a building, right? A main cost for commercial real estate investors is the building itself. And so, or a main investment is the building itself. If that goes down in a fire, a tornado, whatever, what's it going to cost to rebuild that? Well, contractors are more expensive than they used to be. Materials are more expensive than they used to be. All the elements of building a property are more expensive than they used to be, which means we're going to need to insure for more. And then that means obviously the premium is going to be a little bit higher. So that would be the second thing. The third thing is cat losses. So catastrophic scenarios. We've seen a category 4 or 5 hurricane come onto the mainland of the United States in 5 out of the last 6 years, as compared to what used to be 1 year out of 3 or 1 year out of 4. So we're seeing large losses, catastrophic losses at a much higher rate. That's climate change and factors that play into that. Insurance companies pay out billions of dollars in those situations. And so insurance premiums are going to go up. That's the third thing. The last two that I would say that are affecting insurance premium are for commercial real estate investors, there's a lot of roof space, right? If you look at the aerial view of any property you're considering purchasing, you see a lot of roof. And there's a real epidemic of folks trying to get the insurance company to replace their old roof. And we can talk about the ins and outs and that, the pros and cons, but the reality is insurance companies are seeing huge losses associated with roof claims from wind, hail damage, and things of that nature. And so they're having to assess how they handle that. And then the last thing is really the liability scenario in the United States. Florida is one example. The laws in Florida give lawyers a leg up like no other state. The capacity to sue often, sue for lots of money, and have essentially no repercussions if it doesn't go well. Obviously, that's another big conversation. I'll just let you choose which big conversations we want to have, John.
Well,
But
let's break it down, man. You
yeah,
gave a lot
yeah,
right there. So you talked about really Let's see, I think it's five here. We talked about premiums, going up because quite frankly, just the inflation in general is
Yep.
driving everything up. The second thing is the cost to rebuild, both from a material standpoint as well as contractors. That cost has gone up. The third thing is this is starting to get into the environmental side. But you said a great quote. You said 5 of the last 6 years, we've seen a category 4 or 5 hurricane touchdown on the mainland of the United States. And in the past, that was only maybe one every 4, one every 5 years. So that's something that is driving up claims. Roofs, a lot of investors are seeing, roof damage or filing roof claims. So that's something else that's driving up these premiums. And then the last is the liability, the ability to sue, particularly in Florida. That's something else that's having a big impact. So let's back up, right? Because I know sometimes people underwrite deals and they put in maybe like $250 or $300 a door as a placeholder for their insurance quotes. And I know that that number has gone up in some instances. Talk to us about, what you see and what you advise investors to do in the early stages of figuring out what they should be looking at for an insurance premium.
Absolutely. So across the country, you can still see in some small places a $250 a door scenario. You can see a $2,000 a door scenario. And so it spans really, really largely for different places. For Texas, Louisiana, and certainly Florida, we're seeing numbers that are, in that $1,200 to $1,600 a door, especially if things are coastal. Probably Florida is going to go up, given Ian and everything that's going on there. Texas has gone up drastically in the last year. It's now settling a little bit, but earlier this year, we really saw super high premiums because one of the biggest property insurance providers in Texas, a company called Strata, essentially collapsed. They didn't totally collapse, but in a lot of ways collapsed. And so people were left with really high premiums. So the answer to that question is incredibly varied. Now, I have a simple tool on my website, shineinsurance.com/ballpark. That's a 9 yes or no questions. You can get a ballpark for the property that you're buying. So that's helpful. But I would say in general, if you're inland, if you're in the Midwest, if you're in a place that doesn't have really high loss scenarios, a lot of hurricanes or things of that nature, somewhere between $400 and $600 a door is probably what we're looking at for most of those places. If you're purchasing a property or considering purchasing a property that's coastal, it could be as low as $900, but I would throw a $1,300 number in there at least. More importantly, though, John, I would probably reach out to someone either through that multifamily ballpark or through a trusted advisor and get a number even before you submit LOI. I mean, people text me all the time with properties and I can give them a ballpark. That's not a final number. It's not exactly what it's going to be, but it gives them a number that they can put responsibly into that pro forma and build a business plan that has particularly that one line item that is solid, conservative number that helps them to move forward.
No, Jeremy, I think that's very helpful. And while we're talking about the premiums, we may be doing this a little bit backwards, right? Because part of it is also understanding, well, what does that policy actually cover? And if these numbers seem a little bit higher to you, part of it's because, I know you talk a lot about risk management, and we don't want to have the bare bones policy, right? We don't want the check the box policy. We want the policy that's going to allow you to sleep at night as an apartment investor or a commercial real estate investor. So talk to us about some of the things we need to be looking for in these policies or making sure that we have to ensure that we are actually protected.
Absolutely. So I think, like you said in the intro, I really think about 80% of real estate investors have policies that won't serve them in a loss scenario. And that really comes from the idea that it's a commodity, the idea that I just want to buy it at the cheapest price. The fact that commercial real estate insurance is very profitable for agents. We make about 10 to 12% of the premium you pay on the insurance policy. So if you've got an apartment complex, a 100-unit apartment complex, that could be a $60,000 policy. That agent is looking at making $6,000 or $7,000 from this interaction. Their likelihood of deciding to go low and give you maybe not the best coverage so they can win if they're in a bidding scenario is incredibly high. And this is why bidding commercial real estate insurance is so dangerous. You just end up with a junk policy that isn't going to serve you. So what you want to have first is an advisor that you trust. I mean, this is true for lawyers, accountants, property managers, other members of your GP team. Every single person in your commercial real estate journey, it should be a part of your team. And if you trust them, then that's half the battle, right? Yeah, you should trust but verify. Yeah, I'm about to tell you some things you can see in a policy to make sure that it is what you actually need. But ultimately, if you don't trust the person who's supposed to be the advisor for that role, then you've got a major problem and you're so much more likely to have problematic coverage. So number one is picking an advisor who explains things simply, who comes at it from a perspective of doing it right. Yeah, has access to the best prices, 100%. You want that, but has access to the best prices for the best coverage. So how do you know if the coverage is good? Just a couple of top things. One, obviously, is that building coverage. We talked about the building coverage being one of the most important things. If a building goes down, can you replace it, right? So if you have building coverage on a building that you're insuring, and you look at that number, let's say it's an apartment complex, and it's insured for $70 a square foot. You could ask a contractor and say, hey, what could you rebuild that for? Pretty sure no contractor is going to say anywhere in the country right now they can rebuild an apartment for $70 a square foot. It's much more likely to be $110, $140 a square foot is where they're going to land. So you have that insured for like half the amount. There's a red flag right there, right? So the first one is the building insured for enough? You don't want to insure it for the market value. Market value has nothing to do with insurance. You want to insure it for the replacement cost, how much it would actually cost to replace that building. And if you have that wrong, that's a big red flag. I think other red flags get in the weeds a little bit, but there's something called ACV coverage. This is a limited coverage that only gives you the actual cash value of the replacement of a building. So if you think about a car, if you have a 2005 Toyota Camry and you get that Camry in an accident and it's totaled, you don't expect the insurance company to go out and buy you a 2022 Toyota Camry, right? That just makes sense. They're going to give you the amount of money that '05 Camry was worth. And, that's a fair trade. They're making you whole by making sure you can go out and get another 2005 Camry. That is actual cash value. They're going to give you the depreciated amount, not the amount it would cost to buy a brand new Camry. That can get applied to property. Let's think about a roof. When I have a roof, if I need to replace it and it's going to cost me $50,000 to replace it, but the insurance company says, well, that roof is 15 years old, so I'm going to pay you $20,000 because that's what that roof is worth. That doesn't make any sense. You can't go out and buy a 15-year-old roof. That's not how roofs work. You have to buy a new roof, and that becomes a problem. So if you see ACV anywhere on your insurance policy, that is a red flag that you need to talk with your insurance advisor about a little bit more, because when you have depreciated payouts, then you're getting $20,000 instead of the $50,000 it's going to cost to replace that roof. You're pretty unhappy about that. The last one is a co-insurance clause. So if you underinsure and there's a co-insurance clause, then you get additionally penalized for having underinsured. So not only are you not going to have enough money to replace that building because you underinsured, but you're also going to get a penalty even on small claims. So an example would be, I have a $40,000 kitchen fire. I should have insured my building for $1 million, but I only insured it for $700,000. If I have 100% co-insurance clause on that $40,000 claim, the first thing they'll do is take away 30% because you insured for 30% less than you should have. So that $40,000 claim goes down by $12,000. Now you're already only getting paid out $28,000 before the deductible, before any other things. So these are the kinds of things on insurance policies that if you don't understand what's happening, it really, really hurts in a claim situation.
Man, you just gave a masterclass, Jeremy. I mean, just to reboot a little bit of that, you talked about making sure that we have the value to rebuild the property, not just market value. So make sure you're paying attention to that. The second thing is ACV, or actual cash value, in particular when it comes to, roofs and things like that, because you can't actually go out there and get kind of an equivalent roof of 15 years. So you're going to have to get a brand new roof, making sure that that's worded properly and you've got the right coverage there. And then the last thing is this co-insurance clause, which means that you actually have enough coverage or the proper coverage so that you're not penalized when you go to make a claim. So just great points there. And I think it's things that, many investors just aren't aware of and aren't privy to. So really important to understand these elements. Again, Jeremy, you mentioned that if people want to get a free quote or a ballpark quote, they can go to your website, shineinsurance.com/ballpark. And I implore anyone to check that out so you can learn a little bit more. Let's take this to the risk space we were at before, right?
Yeah.
So obviously insurance claims can be one thing. We look at, the various risks of the deal. One thing you just talked about was that I think Strata, you said was the company Strata collapsed. What do you do in that situation? How do you make sure you're going with the right vendor? Because if there is a company that collapses, I mean, what happens to your policy at that point?
Yeah. So, in that scenario, what Strata basically what happened was, so in the insurance world, you have a company that it could be the Liberty Mutual or the Travelers or the Strata or whoever, the people who are in the front, right, that have the brand name on it. But behind that, for almost every insurance company, they purchase insurance as well. So, especially for catastrophic losses. So, what insurance companies do is they say, look, we will take on $10 million of a claim, but we're going to purchase our own reinsurance policy. And if there's anything more than $10 million, that other insurance company is going to pay that. So there's usually insurance companies behind insurance companies that are ready to pay out in those big catastrophic losses. What happened with Strata is they had the big catastrophic loss of the freeze in 2020, I believe it was, in Texas. And their reinsurance company at the renewal said, hey, we're not interested anymore. We got hosed in that
Mm,
situation, and we're not going to offer reinsurance to your program anymore. And so, because Strata couldn't go out and find reinsurance, and of course, they didn't have enough capital to be able to handle a big catastrophic loss if there was another one, that the program essentially collapsed. So that didn't mean that all the policies just didn't count anymore. They figured out how to replace those policies, or they just at renewal told people, hey, we're not going to replace your policy. You're going to have to figure something else out. And so there was a scramble in Texas because all these property owners suddenly had non-renewals. Um, and so there weren't a bunch of insurance companies in Texas that were raising their hand to take over all that stuff. And the ones that were raising their hand by a process of supply and demand, of course, there's low supply. And so the price is going to go up. And that's kind of what happened there. I don't know if I answered your question or not, John. I got kind of caught into the strata scene.
yeah, no, I mean, I think it's very helpful to give context of what happened with Strata. But so let's say when we talk about non-renewals and some of those different things that happen, from a risk standpoint, how do you manage that as an investor? I mean, what happens if you get that notice that we're not renewing your policy or your premium is going up by, 20, 30, 40%?
Well, it starts with underwriting before the purchase, right? And of course, you can't know everything. I think one of the things you can know is if you're choosing to invest in coastal properties or other types of high risk properties, then you have a high risk of things changing on you. One of my quadrants of risk, when I talk about quadrants of risk, is external risk. If you're investing on the coast, there's some external risk that you can't control. And that means you're putting yourself in a higher risk scenario by making that purchase in the first place. One of those higher risks is the potential for the insurance line item to go wonky on you. If I'm buying a coastal property right now, I'm going to underwrite a pretty high number, and then I'm going to underwrite at least a 15, maybe 20% increase in premium per year over the course of the next 5 years. That might sound pretty extreme, but if it still underwrites well, you have a likelihood of it going better than worse, right? Obviously, the insurance number in Illinois or Pennsylvania or Indiana or Ohio is going to be much different and much less of a factor. So if I know a lot of investors in Florida who just understand this. And so they don't invest in properties on the coast. They're going to invest, further inland. That's just one of their underwriting guidelines. I want to be inland enough where the insurance isn't going to be extreme. I'm not going to buy 1970s frame construction because I know that compounds the excess cost of insurance. And that's just not of interest to me. So that's an investor who maybe isn't taking higher risk. They're looking at all the factors. And I think the key, if there's one thing that folks take away from this conversation, it is to identify, understand, and then manage risk is the key. So if we can identify now, if you're listening to this podcast and you're thinking about buying, say, a coastal property in Texas or Florida, okay, now I have identified a risk, and now you can underwrite for that risk. It doesn't mean you don't buy the property. It just means now you understand that line item. And if your guru, if your coach told you to put $250 a door on a 200 unit complex that's in Tampa Bay on the coast, you now have a new number that is more informed. You have identified a risk. You've kind of understand it a little bit better. And now it's properly underwritten on the front end, which means you can make better decisions about how you move forward. To me, it's all about the business plan and being informed, right? And this is a piece of that.
No, great points there, Jeremy. And you mentioned the 4 quadrants of risk. So the first one being external there, one of them being external. Talk to us more about those 4 quadrants.
So I really believe that investing as a whole is an exercise in managing risk. Due diligence is an exercise in managing risk. Building a business plan is an exercise in managing risk. Making sure properties are safe. All those things are exercises in managing risk. And so what we have to do is figure out how to break that down so we can analyze each of the pieces. So the first quadrant of risk is property risk, or is physical risk, right? This is the physical buildings. This is the property. This is the potential for injuries to employees, contractors, or tenants. So physical risk is quadrant number 1. Quadrant number 2 is relationship risk. This is generally contracts, right? So we're talking about our GP team or our JV partner. We're talking about our tenant contracts. We're talking about our contractor contracts, all the relationships that we have. There's risk involved in them. And in a business engagement, which is what commercial real estate investing is, we want to make sure that all those relationships are as lined out as humanly possible. The third quadrant of risk, like I mentioned, is external. These are risks that you cannot control. That is market changes, politics, the weather, climate change, things of that nature. These are elements of risk that once you pull the trigger on a property, you can't control any longer. You can control whether you decide to invest based on those external risks, but you can't control them after you make your decisions. And the fourth quadrant of risk is systems. We have to have our systems in place as business owners. If we break that down simply, it's basically marketing, sales, and delivery, right? Everyone who owns a business, everybody who runs a business has some combination of marketing, sales, and delivery. And so there's risks associated with failures of systems to be able to handle those pieces. Of course, all of that is financial, because running a business means attempting to make money. And so all of those quadrants are navigating the question of how are we being financially successful.
Jeremy, thank you for breaking that down. You said physical risk, relationship risk, external risk, and then last is going to be your systems, right? Which is really marketing, sales, and delivery of whatever that product or service actually is. Great insights right there, Jeremy. Let's talk a little bit about your podcast. You've been hosting the show for a little while now. Give us a little bit of context of what the show gets at, where can our listeners find it, and a little bit more about the show.
Yeah, so the show is called Managing Commercial Real Estate Risk. It's essentially exactly what I've been talking about in this conversation and really helping, because I think some of the smartest investors out there, I realized, really understand the idea that thinking from a risk perspective is everything. Because if we can manage it, we can take bigger risks. And that's the dichotomy, sort of the blow your mind idea that I try and get across in my show, that the more we understand risk, the bigger, in quotes, risks we can take. When you see people purchasing $20 million, $80 million, $200 million properties, These folks have learned to manage risk. They have built the foundation. They understand the quadrants of risk. They have teams in place that are helping them to facilitate those decisions. So when the opportunity comes across their table to do a $100 million deal, they can pull the trigger quickly and pull the trigger successfully. And so I interview mostly asset managers, acquisitions managers, and all members of GP teams, asking them about how they manage risk in their acquisitions process, in their asset management process, in their exit strategies, and everything in between.
And the thing I love too is like, when we think about investing really is a matter of managing risk, right? We're trying to figure out how do we manage our dollars, manage our finances, figure out which investments we want to get into. And a lot of that decision making is a process of elimination on risk, right? Do we like the market? Do we like the team? Do we like the deal? Do we like the business plan? What could go wrong in a business plan? Do we feel like we have options, set aside in case that happens? Do we have proper reserves? What's going on with the loan? Right? All these things are kind of a series of decisions that help us understand how much risk is involved in the deal. We even talk about risk adjusted returns. So I think it's really important for people to understand risk, not to be scared of it or concerned with it from that standpoint, but just to understand it so that as you're making decisions or looking at opportunities, you can properly evaluate what risk you are willing to take, but also understand how to mitigate that risk as much as humanly possible. So we'll make sure we put a link to your podcast in our show notes as well. And for investors who want to learn more or check out that ballpark estimating tool that you have, again, it's shineinsurance.com/ballpark. Right now, we're going to go to our round of insights. You ready?
Absolutely.
All right, Jeremy, give me a failure or an apparent failure that sets you up for later success.
I think that just the lack of willingness to reach out to people on that marketing piece, right? I talked about the fourth quadrant, and I've always felt like, oh, I'm too nice, I'm too kind, I'm too not a salesperson. And when I learned that it's really just about having the guts to reach out and having the capacity to add value, I think that's what set me up for success.
Love it. Give me the book you recommended or gifted the most in the last year.
So Jay Baer's Utility is the one I give out the most. His books are all great. They're not commercial real estate investing books. They're marketing books. But he, Hug Your Haters and Talk Triggers and Utility. All his books are great.
Love it. Give me a digital or mobile resource you recommend for your business.
Trello runs a lot of my internal workflows and how I keep my systems really, really solid. I know there's lots of different ways to do it, Monday.com, Asana, but I love Trello, and it really sits at the center of my tech stack.
What's a daily habit that helps you stay focused on your goals?
A daily habit that I need to break is sitting at this desk too long. But I think that one of the daily habits that I really get into is going for a walk, listening to podcasts, really just making sure that from noon to 1, I get out of the house, I go for that walk, I connect with myself, with my story, with whatever it is that I'm trying to listen to. Sometimes it's just social podcasts, sometimes it's business podcasts, but that's what I do.
Give me your number one insight for managing risk.
Identify. There's 3 types of risks. Risks you can do something about, risks you can't do anything about, and risks you could have done something about had you known about them. Focus on making sure the third is as small as possible, identifying those risks, because once they're identified, then you can understand them and manage them, and they're no big deal.
I love it, man. Great points there. Let's lighten the mood, man. You are out there in Bloomington, Indiana. Give me your favorite place to grab a bite to eat.
So Uptown Cafe, absolutely one of the best places in Bloomington. Been around since the 70s. Used to be the place where, like, when everyone poured out of the bars at 3 a.m, they had the greasy food. They had like late, I think they opened at 4 a.m. and closed at like 10 a.m. So it was like greasy late night and then, breakfast. But now they're much more kind of upscale. They've been around for a long time. Michael Cassidy is the owner of that business. Absolutely wonderful human. So yeah, if you're cruising through Bloomington, Indiana, Uptown Cafe is absolutely the place to stop by.
I love it, man. We got to put that on the list. Jeremy, listen, always a pleasure to talk to you. You gave some great insights on managing risk, helping us understand what's going on in the insurance world right now and maybe why some of these premiums are going up, but also making sure that we get the right coverage for our policies, right? make sure we get the right coverage on these properties. We want to make sure that, everything is covered properly and we can get the insurance that we need, not just the cheapest premium. So with that said, again, if you want to listen to or check, if let me say this differently, if you want to listen to Jeremy, you can check out his podcast, Managing Risk or Managing Commercial Real Estate Risk. And that's anywhere you listen to podcasts. We'll put a link to that in our show notes. And then also, if you want to get that ballpark estimate for multifamily investing, you can go to shineinsurance.com/ballpark. Jeremy, I want to thank you again for coming on the show. Hope you have a great day, and we look forward to staying in touch.
John, it's always a pleasure. Thanks for having me.